Good morning, or hi everyone, and welcome to this session today, our International Trade Week session. My name's Glenn Collins, and I'm head of Technical and Strategic Engagement at ACCA. ACCA is the Association of Chartered Certified Accountants, and we're a global body of accountants with 773,000 members and students in 181 countries. We're proud to support International Trade Week as we know the value it brings both to our members, but actually also out to a wide range of different businesses. And actually, importantly, getting businesses on the right track. And we know how vital that is when you're looking at international trade. Our session is one in a series that we are running, and these are pre-recorded sessions, or these are recorded sessions, and will be available as well over the coming months. So they cover trade remedies, AI, cyber, and around the world trip with some of our accountants from different countries. The session today is one of those really important factors that we know can really hinder on international trade. And we're going to cover the business environment, both internationally, some of the economic threats, and actually how you obtain appropriate and sustainable finance. And we're joined by ACCA's Chief Economist, Jonathan, and also a very, very valued friend and partner of ACCA, Paul from Capitalise. Before we start, please do keep microphones on mute, and please do use the chat function for any questions. And Bridget and I will be asking those for Paul and Jonathan at the end of the session. So please keep those coming through. Jonathan, over to you, and give us some of that great economic and business environment insight that you actually have.
Yes, well, thank you very much, Glenn, and good morning, everybody. And thank you very much for attending today's session. I'll just share my screen now. Over the next 20 minutes, I'm going to discuss the results from our latest Global Economic Conditions Survey of accountants and finance professionals from across the globe, as well as my broader global economic views. I think the title of the presentation nicely captures the key takeaway, that the global economy has slowed, but there's no indication at the present time that a major downturn is imminent. This chart shows the key indicators from our Global Economic Conditions Survey. The blue line is the closely followed Global Confidence Index. And you can see this declined over the recent quarter for the second consecutive quarter. And we also saw declines in our other key indices: new orders, capital expenditure, and employment. But I think it's important to stress that the decline in our indicators over recent quarters has been relatively modest so far. So it's pointing to a slowing global economy, but there's no indication that a major downturn is offing in the global economy at the present time. Indeed, our key indicators still remain close to their long-term average levels. If you look at the left-hand side chart, the blue line is our Global Confidence Index. The blue dashed horizontal line is its long-term average. And you can see confidence is close to its average levels at the present time. The right-hand side chart shows similar metrics for our new orders, employment, and capital expenditure indices. As you can see from the red line, new orders are around their long-term average levels, whereas the yellow line shows that employment is actually slightly above its average levels, whereas capital expenditure, the blue line, is moderately below average levels. A good cross-check on our key global economic indices are what we call our global fear indices. These measure concerns amongst accountants about whether their customers could go out of business or whether their suppliers could go out of business. And I think if you look at the chart at the present time, there's little fear evident in our fear indices. The red line shows concerns about customers going out of business. It ticked up slightly on the recent reading, whereas the blue line shows concerns about suppliers, and that continued to fall back. And I think the key message is neither series looks particularly alarming by historical standards at the present time. And I think that's quite surprising given the aggressive pace of global monetary tightening over the past 18 months. Indeed, it was equally surprising that the global monetary tightening has had not that much impact on our indices that measure global problems accessing finance or global problems securing prompt payment. If you look at the red line, problems accessing finance, you can see that actually eased slightly in the latest quarter. And that was the same for global problems securing prompt payment, eased back slightly in the latest quarter. And once again, neither series looks particularly alarming by historical standards. In truth, going forward, I'd be very surprised if we don't get some deterioration in some of these indices, given the lagged impact of that policy tightening, and also given the sharp move higher we've seen in government bond yields since the summer. Other economic indicators have also pointed to a slowing in the global economy recently. The red line on the left-hand side axis is the closely followed JP Morgan Global Composite Purchasing Managers Survey. The blue line on the right-hand side axis is the annualized quarterly change in global GDP. And you can see that the global composite PMI has moved down quite smartly over the recent quarter, and it's consistent with a slowing in the global economy. And the survey for October slowed further. That's not included in this chart because this chart was quarterly. And it's interesting when you look at the sectoral breakdown of the JP Morgan Composite PMI. The manufacturing purchasing managers index has been very weak for quite an extended period of time. But this move down in the global composite PMI recently has been driven by a weakening in the previously resilient services sector. This weakness in the global manufacturing sector is clearly evident in the global trade data. This chart shows a 12-month percentage change in global trade volumes. And at the present time, they're currently declining by almost 4% on a year-on-year basis. And this is the weakest pace of decline in the last few decades, outside of the global pandemic, the great financial crisis, and the US recession in 2001. Digging beneath the global levels in our latest global economic conditions survey of accountants, there were some really interesting developments at the regional level. This chart shows the change in confidence at the regional level in the latest quarter. If you move to the right-hand side of the chart, you can see there was a very, very sharp decline in confidence in North America. And this was quite striking because it came on the back of 4 consecutive gains previously. The decline in confidence in the US was not quite as marked as the wider region, but it nevertheless would suggest that the first cracks could be beginning to appear in the previously resilient US economy. As you can see from the chart, we also got another decline in confidence in Western Europe, and that came on the back of quite a marked decline in the previous quarter. Although this was not that much of a surprise, given the current weakness in the euro area economy and the current weakness in the UK economy. Moving towards the left-hand side of the chart, you can see we got a modest rise in confidence in Asia Pacific. And that was quite notable because we got a very, very sharp decline in confidence in Asia Pacific in the previous quarter. I suspect that tentative signs that the Chinese economy is beginning to recover could be the factor driving the stabilization in confidence in Asia Pacific. And it was just interesting on the far left-hand side of the chart, for the second consecutive quarter, we got another solid increase in confidence in Africa. And obviously, Africa is a very large continent with lots of diverse countries, so it's quite hard to exactly pinpoint the drivers. But I suspect the declines in inflation in many countries over recent quarters could be beginning to lead to the improvement in confidence across the region. Just digging down a little deeper in some of the key global economies, the US economy has been very, very strong this year. Growth was almost 5% in the third quarter, which is close to triple its trend rate of growth. And the strength in the economy is evident by the labor market, which still remains very strong at the present time. This chart shows the 3-month moving average change in US non-farm payrolls, and it's still tracking a healthy rate of around 200,000. And you can see outside of the pandemic rebound period, this is quite a decent pace of expansion by historical standards. So I think the question people may ask is, how did we get quite a large decline in confidence in North America and the US in our survey of accountants, given that the economy is so strong? But I suspect accountants may be picking up on something, because I think the US economy is likely to slow quite materially in the fourth quarter and in early 2024. I think some of this will just be natural payback after the really, really strong growth in the third quarter. But there are a number of drags building for the US economy. These include the resumption of student loan payments, the lagged impact of past aggressive monetary tightening, the soaring in government bond yields since the summer, which has seen mortgage rates hit the 8% threshold. And there's also still a risk of a government shutdown in November. And I think it's important to also point out that the excess savings built up by households during the pandemic have been a key support to the US consumer over recent quarters in the face of aggressive US monetary tightening. But evidence is beginning to suggest that these excess savings are being close to whittled down. So this key support to the US economy may be much less of a support over coming quarters. And as I mentioned, there have been signs of stabilization in our indicators in Asia Pacific. But I think it's important to stress that even though the Chinese economy is showing tentative signs of improving, I don't think we should expect the robust type of recovery that China has often recorded in the past. I think policymakers are being quite cautious in the amount of stimulus they're willing to provide to the economy. And the housing market continues to provide significant headwinds. And I think the recent Purchasing Managers Survey for China threw a note of caution to some economists who are beginning to perhaps become a bit excessively optimistic about the prospects for recovery in China. If you look at the right-hand side chart, this shows the closely followed MBS Purchasing Managers indices. The blue line is for manufacturing and the yellow line is for non-manufacturing. And you can see that both fell back slightly in the latest readings for October, and they're both close to the 50 threshold marked by the black dashed horizontal line. That denotes the difference between expansion and contraction. So I think we are likely to see a continued gradual recovery in the Chinese economy, but we certainly shouldn't expect a robust recovery like we've typically seen historically. Just turning to Western Europe, the Euro area economy contracted slightly in the third quarter, and it looks as though it's on course to contract again in the fourth quarter. If you look at the left-hand side chart, this shows the flow of new bank loans in the euro area, and you can see they've largely ground to a halt over recent quarters on the back of the aggressive policy tightening by the European Central Bank. And you've also seen significant slowdowns in housing markets across the region. And the region's important manufacturing sector, particularly in Germany, is very weak at the present time. But it's not all doom and gloom on the continent. If you look at the right-hand side chart, you can see that the euro area unemployment rate is close to historical lows at the present time, despite tentative signs of easing. And this tightness in the labour market has been driving pretty strong wage growth on the continent. And that's happening at the same time as inflation has been falling back very, very sharply. So the prospects for real income growth for households are improving on the continent. So I think the strength of the labour market and improving prospects for real income growth is quite important. It just suggests that even though the economy looks as though it's on course to contract again, it doesn't seem likely to be a significant downturn in the economy on the continent. Just moving closer to home in the UK, the Bank of England recently produced a sobering set of economic forecasts, and it's expecting little in the way of UK GDP growth over the next 18 months on the back of monetary policy remaining very tight. I don't disagree with the Bank of England's view, so I won't delve too much into the UK economy, but I thought it'd be interesting to show you some results from our latest Global Economic Conditions Survey for UK SMEs. If you look at the left-hand side chart, this shows confidence amongst accountants and finance professionals for UK SMEs. And as you can see, confidence improved in the very latest quarter, although it came on the back of a very sharp decline previously. And confidence amongst accountants at UK SMEs still remains below its average levels, denoted by the blue dashed horizontal line. And I think it's interesting, if you look at the right-hand side chart, the indices for employment and capital expenditure point to quite significant caution on behalf of UK SMEs at the present time. The red line is the index for employment. The blue line is the index for capital expenditure. And you can see their averages denoted by the horizontal dashed lines. You can see both indices fell in the latest quarter, and they remain below their long-term average levels. Capital expenditure looks very weak by historical standards, and it's not far above the trough recorded during the pandemic. But it's not all necessarily gloomy when looking at our indices for UK SMEs. The results we've seen for problems accessing finance and problems with prompt payment have actually been better than I may have thought in the last couple of quarters. If you look at the left-hand side chart, this indices shows problems accessing finance for UK SMEs. And as you can see, there's some deterioration in the index over the latest quarter, but it's only modestly above its historical average, and the series doesn't look particularly alarming at this stage by historical standards. And if you look at the right-hand side chart, this shows problems securing prompt payment for UK SMEs, and there was quite a sharp fall in the index in the very latest quarter, and it's currently around its long-term average levels. A similar story was evident if you look at the indices measuring concerns about customers going out of business or concerns about suppliers going out of business. If you look at the left-hand side chart, this measures concerns about customers going out of business, and you can see you got some easing back in this index in the latest quarter, and it only remains modestly above its long-term average. Whereas if you look at the right-hand side chart, this shows concerns about suppliers going out of business, And as you can see, this index largely flatlined over the latest quarter, but it's below its long-term average level. And given it's International Trade Week, I thought I'd show you our index that measures opportunities to enter new markets according to UK SMEs, and that this is denoted by the blue line. And we got quite a large improvement in this index over the latest quarter, suggesting that there was increased opportunities to enter new markets. And I will highlight the new markets is not strictly defined, so that could include new geographies or new product markets. But we got an improvement in this index over the latest quarter, although admittedly this has been quite a volatile series historically, and the current reading is still below many readings that were recorded in the last decade or so. Just turning to inflation, there's been very encouraging inflation trends globally over the last few quarters. Headline inflation has fallen quite sharply in most economies across the globe, and core inflation has also begun to move down as well. This chart shows our index measuring concerns about operating costs according to accountants globally. And as you can see from the red line, concerns about operating costs have eased back over recent quarters and continued to fall back over the latest quarter. But I think it's important to stress that concerns about operating costs still remain very elevated by historical standards. And I think that would support the message coming from elevated and sticky service sector inflation in advanced economies, that it's still way too early for central banks to declare victory in their battle against inflation. And I think the risk still is that some central banks may need to tighten policy further, particularly the Fed and also the Bank of England. The financial markets are now pricing in modest policy easing by the major central banks in the second half of 2024. And I think the risk to this view is definitely on the upside. And some central banks could still even have to tighten further. So I think the big picture over the next 18 months is monetary policy rates are going to remain high. So I've highlighted a central case scenario of a global economy that's been losing some momentum, but I've suggested there's no clear evidence at the present time that a major downturn is in the offing. But I think the risk to this view is quite heavily skewed to the downside at the present time. I think importantly, there's a significant risk that the lagged impact of past monetary tightening potentially leads to a hard landing in a major advanced economy such as the US or the Euro area. And there's still significant risks of financial accidents like the one we saw in the US earlier in the year. And I think the sharp spike in government bond yields further increases these risks. And I don't think it's going to be a surprise to you when I say that geopolitics is going to be a big risk to the global economy going forward, given the events in the Middle East and the ongoing developments between Russia and Ukraine. I think JP Morgan Chase CEO Jamie Dimon very nicely captured the mood in comments in his latest quarterly earnings statement. Dimon suggested this may be the most dangerous time the world has seen in recent decades. And I think there's clearly a risk that geopolitics could lead to sharp increases in oil prices. And that would obviously hit household incomes pretty hard across the globe. And it would make central banks' task of getting inflation back to their targets very, very tricky. And I think developments in the Chinese economy will continue to pose risks going forward. So just to conclude, according to our Global Economic Conditions Survey of accountants and finance professionals across the globe, global confidence has declined for the second consecutive quarter. The global economy clearly looks to have slowed. but there's no evidence that a big global recession is on the cards at the present time. And according to finance professionals in our survey, confidence fell sharply in North America, perhaps suggesting that the first cracks may be beginning to appear in the US economy. But they saw some signs of stabilization in Asia Pacific, possibly due to signs that the Chinese economy is beginning to recover. But going forward, the growth risks to the global economy are heavily skewed to the downside. Thank you very much.
Thanks, Jonathan.
Paul, and over to you to look at some of the reasons why you should be preparing now, and some of your insights as well.
Fantastic. Thanks, Glenn. Thanks, Jonathan. That was a fantastic view of the macro insight from an ACCA perspective, and also your survey. So my name is Paul Surtees, CEO of Capitalise, and I will try and sandwich, I guess, what Jonathan's just done from a macro perspective. So I think since the oil shock crises of the 70s, we globally have all benefited from some mega trends. And whilst Jonathan touched on some of the impacts of those over the last quarters, really I'm trying to think about this over the last 30 or 40 years. And we've all benefited from cheap money, cheap goods, and cheap energy. And the reality is that, given what's happening in the world, the geopolitical risks, the pandemic, some of the challenges that Jonathan's put forward, we've actually entered into a new regime where actually that cheap money, those cheap goods, and the cheap energy has been cancelled. Jonathan talked about the geopolitical risk and the potential for oil prices, but cheap energy is also going through a massive global phenomenon, in terms of the net zero and the green move, which also has got, trillions of pounds associated to it. And whilst the US might be calling it, the Inflation Reduction Act, there's a huge amount of fiscal stimulus going into economies to try and solve that problem, which can in and itself rotate into inflation. So we have these problems ahead of us. What I want to try and do is to give us some context relative to where we are from an interest rate perspective, and how as businesses, when we start to look at us from our own micro perspective, how we can translate through that. So when we look at what the Bank of England have done, we've been through 14 rate rises through this rate hike cycle. We're currently sitting at 5.25. We've had two pauses. The last rate cycle was actually what I call a hawkish hold. 3 of the 9 MPC members actually voted for an increase in rates, probably led by Catherine Mann, the more hawkish on the committee. The other 6 voted to hold. So there is this propensity for us to be worried about where we're going, and ultimately the central bank wants us to return to 2% inflation target, because the longer that this is up here, the more volatile rates are going to be over time. And when you think about the capex expenditure that Jonathan was talking about from a confidence perspective, if we don't have confidence about the cost of funds and what the investment universe looks like over the months, quarters, and years ahead, then we will tend to be more risk averse, sit on our hands, and not go forward. So there's huge impetus for the Bank of England and central banks more widely to try and get this right. But of course, they've effectively got it wrong over the last 24 months or so by thinking that inflation was transitory. And I think the risk is actually to more rate hikes and more tightening from a monetary policy perspective. So what I'm going to talk through today really is how we can think about rates, how we can approach the market to get cheaper pricing, how we can be open-minded about the funding that we might access, but equally some of the tools that we can use to reduce those costs. So I'm going to go into a little bit of detail in terms of thinking about cash flows and planning, thinking about your credit limits. Jonathan touched on concerns around your clients going out of business and also your suppliers and the impact of that from a supply chain perspective. That doesn't just apply here in the UK, but also on a more global basis. So what are the impacts of your supply chain getting a little bit wobbly? So let's have a look if we go through these pieces. So business planning. This might feel like a little bit of back to basics, but ultimately, you've got to go through the process of making sure that you have a strong business plan in place. And, ideally, you want to be doing that with your accountant so that you've got somebody to cross-check that with, to go through it, somebody who's done this, hundreds, thousands of times through their business so that they can pick you up on, on any challenges that you might have made. Really what you want to be doing is, whether it's the strengths, weaknesses, opportunities or threats, whether it's doing it on a business canvas, whatever the methodology is that you want to try and get it out in words. You want to build out those requirements. And what's really, really important here is that it's not the document. It isn't the cash flow itself. It is the process of doing it. It's the process of thinking through and thinking what it is your business is going to be doing over the, the weeks, months and quarters ahead. I think what we learned going into the pandemic, it's all well and good having a plan. Let's just call that your base case. But you really must have a best case, and you should also have a worst case so that you've done a little bit of stress testing in that context. And through that journey, you should be evidencing your assumptions. And in doing that, you can start to build that into your own KPIs, your own objectives and key results, as we call them as OKRs, and we use them at capitalise.com. What we do ultimately is have 1 or 2 business goals that flow through to every single individual in the organization so that everybody can understand what their contribution is into achieving those goals, which ultimately then are attached to your cash flow. So it's a living, breathing piece of work. It's not a document. It's not just a cash flow that gets dusted off for board meetings. It's something that you've got to live with, okay? Finally, like within that space, working capital, really, like, I guess the second half of this webinar and the rationale for this is like, how do you maximize your working capital? And the way in which I look at it is that there's the internal working capital and there's the external working capital. You've got to make your internal working capital work for you. You've got to make sure that your credit score is as high as possible, that the credit limit that you have is maxed out so that when you're going to your suppliers, you haven't got 10,000, you've got 30,000. And if you've got 10 suppliers, that's £300,000 of free credit. Getting your accountants to help you with your credit control to make sure that you're making sure that that is as short as possible, that you haven't got kind of debtors at risk, that you're credit scoring your clients so that you understand that you're not extending credit. You might be offering 30-day, 60-day, 90-day terms. I bet you've never thought of yourself as a lender before, but that is effectively what you're doing when you're offering those terms. You're offering credit, you're offering terms to clients. To what extent are you considering the credit risk of your clients? So just make sure that that is really tight. These are the 3 key components. And as I said, just kind of like really iterate this. It's not the document. It's not the process of the credit control. It is making this living, breathing and making sure that it's absolutely wrapped into everything that you're doing within your business. So cash is king. We know that, whether it's the kind of the turnover that we're tracking. And if we, look at things like zero metrics, the Zero Business Index, the last one that came out in September is actually suggesting that revenues are going down in the UK, which is obviously a little bit in line, I guess, with some of the growth challenges that we're seeing from a GDP perspective here in the UK. So making sure that you've got a cash flow out. This is obviously a really, really simple 13-week cash flow. Obviously, if you think about the degrees of freedom within your business, the further out you go, 1 year, 2 year, 3 year, 5 years from a cash flow perspective, there are more degrees of freedom, more things that are going to come in, pandemics that we never thought that we would have. There are going to be curveballs that are going to come in and change everything, which is why you need a good base and worst case. But make sure that you've got a 13-week cash flow because you should know what's happening. If you're offering terms for 30 days, okay, or 60 days, these are the components that are sitting in. You know what you've got to pay, you know what you should be paid, you know who you're paying from an employee set and so on. So make sure that you're at least running a 12 to 13 week. And again, that collaboration with your accountant is absolutely key. That collaboration as an accountant to your business is absolutely key because you've got the knowledge, you've got the insight, and that's what you need to deliver into these SMEs to make sure that they're stable because we are entering a stagflationary environment that's going to be challenging. If growth is going to be challenged and we've got inflation type challenges on a global basis, it's going to be tough for us businesses out there. So make sure that these are out there and that we're managing that cash appropriately. When it comes to lending, you'll be surprised. I mean, we have achieved something like 1.75 billion of approved capital or something through the marketplace at Capitalise. We're very rarely asked for forecasts in terms of the supporting data for lenders. Most of it is around the security that we've got. Most of it is around the affordability. But where the funding is more complex, where you're going to a tier one bank, where it is more around what is happening in the future, cash flows are going to be absolutely critical to that context, and that's where we are asked. Okay, so let's just think about the credit risk, credit scores. Commercial Delphi is a risk score that Experian have built. There's just under 100 risk factors that kind of go into it, and it ultimately presents a credit score that marks you out of 100. It's a horrible score to some extent, but it's a lovely score. The reason I say that it's horrible is that it is effectively a very technical lender piece of kit. It effectively is the probability of default over a 12-month period. Okay, so this 68 out of 100 is effectively presenting this business, call it Acme Limited, that it's got a 68% chance of making all payments within a 12-month period. So a credit score is really, really important when thinking about the credit that you can get from a lending organization, whether it's a high street bank, whether it's an independent, whatever it might be. But it's also really important from your suppliers. They're looking at you on this basis to think about, can they actually extend limits? So one of the things that we help businesses, about 140,000 now in Capitalise, is enabling them to understand what their credit score is, what the credit risk factors are, what their payment performance is, how third parties are looking at them, all in a dynamic manner so that you can start to get on top of this. And this is an absolutely critical part of that internal working capital that I talked of. So let's just kind of delve into it a little bit deeper. So why are credit scores important in the SME lending space? Well, there are basic lending hurdles. If we think about this probability of default concept, Commercial Delphi, then if you're a very low risk business, you're scoring 91 to 100. Okay, that means that you've either got 9 to 0% chance of defaulting within a 12-month. There is a basic hurdle with which lenders will lend to you, and it's about 45, 50, mostly 50 Commercial Delphi points that you have to achieve in order for a lender to lend you money. It doesn't really matter what the product is, whether it's asset finance, trade finance, invoice, etc. There is a basic hurdle that your business will need to achieve in order to get funded. There's a second component to this, which is supplier credit that might get given to you. Now, if you think about the easiest example that I could probably think of is as a builder, for instance. You go to Screwfix, you go to Trade, Travis Perkins. Those businesses absolutely want to sell you screws, wood, all the kit that's needed to provide a, commercial building, residential, whatever it might be. They obviously make a margin on what they sell you, so they are going to offer credit to lower credit scores than lenders will, because they're making a margin on their product. Okay, and that can go down to about 15, 14 from a Commercial Delphi perspective. But the amount of supplier limit that you're providing is determined by this score. So why wouldn't you want to have the highest possible score so that you can not have £10,000 of limit, but £30,000 worth of limit? So I'll come on to that in a bit. So if we just kind of have a quick look at this this chart, there's a bit to kind of chew on here, but the blue bars are the number of SMEs or owner-managed businesses that are created within a given year. If you look at the year one, ultimately there are about 750,000 incorporations. The businesses are up to a year old. If you look at where their mean and upper quartile credit score is, it's about 15. Why? Because they haven't filed any accounts. There's no really any information out there. They haven't been paying to utility companies, whether it's energy or other suppliers like the Travis Perkins and the Screwfix. There's just not much data out there for a credit score to be eligible. If you look at the 1 and 2 year, we've lost about 250,000 businesses. People tried, they realized they couldn't make a go of it, and they've closed. By the time we get to kind of 2 to 3 years, we're at about 275, 300,000 businesses as a cohort. But what's really important is if you look at the black line, this mean line, over time, effectively a credit score improves. And that is merely a reflection of the amount of information that is out there on a publicly available basis. If you look at the purple line, this is the upper quartile. This is what we should all be aspiring to, because the world gets a lot easier. If you think about that lending threshold, okay, effectively, if most lenders are not going to come into the market below 50, 45, effectively, the average business 4 years and below is going to struggle from a borrowing perspective. Just the very basic hurdle of coming in and achieving borrowing is going to be challenged. So some of the things that I'm going to kind of talk through here is really like how can you think from your business perspective, cash flow is king, start to think about the internal capital, all these good husbandry type services that you need to do to try and improve your credit score. So let me kind of give you an example of the art of possible. There's under legislation, credit rating agencies, and we're most closely working with Experian, but Equifax, CreditSafe, Experian, Dun & Bradstreet, whoever it might have to be, there has to be a process for a consumer and for a business where you can go through a complaints process and say, my credit score is not right. A credit rating agency is providing a score on you as a business and you as a consumer to be able to access credit, okay? And you're marked on that. We're now thinking about the average hurdles. The reality is that that process offers an opportunity for us to go through. This particular manufacturing company, turning over £4.3 million, started out before we reviewed their credit setup with a credit limit of £110,000 and a credit score of 56. Having reviewed their information, their credit limit went from 110 to 410, which is a 3.7 times change, and their score went from 56 to 100. Now I'm going to surprise you, shock you even, that this is achievable 96 times out of 100. Okay, and the reason that that is possible is because typically your accounts, whether you're however they're getting filed, will be filed 7 months late. So not late, sorry, 7 months after the your financial year finishes. Okay, and for the vast majority of businesses sub-audit, you're submitting abbreviated accounts. So effectively, there's no information in there. There's just like really skeleton information about a balance sheet. So there's nothing for a credit rating agency, whoever it is, to be able to mark your credit score and to go through that process. So the opportunity is to go through a process like the credit review and ultimately change that. If you take this example, 110,000 to 410,000, if this manufacturer had 10 suppliers, that is now £3 million worth of working capital that they can get at 0% because it's been provided by their suppliers. Why would you not take that? Free capital. And all the more, I started it off 14 rate rises. How do we get cheaper capital? This is 0% working capital. You go through the process, you pick up the phone to your suppliers and you say, my credit rating's changed, my limit's changed, I need a higher supplier limit. Why would you not do that? So let's just take another example. This is a restaurant group, a slightly larger audit. And the reason I'm kind of bringing this is for two reasons. First of all, I'm highlighting that if I went to you as a business and said, I can change your credit score, you say, don't be daft, it's already 100, okay? And we can't change it from 100 to 100, that's impossible, but you can see that the limit can change from 380,000 to 1.2 million pounds, which is a 3.1 times improvement, okay? Why? Because even though it's audit, even though you're providing, P&L data and all of the other supporting information with advice and things from accountants, it's still 7 months late. So there's still a huge amount of opportunity to be able to change the information dynamic from a credit perspective. So let's just try and use that as a platform to move into the SME funding landscape. So at the moment, if you were to go to the Bank of England and look at the lending data, large business lending is falling, small business is falling from a growth perspective. And it makes sense because rates, start at a minimum of 5.25, the bank base rate, and a margin on top of that. So rates are becoming, harder and harder to afford from a margin perspective. But what we're seeing at Capitalise is a huge increase in funding demand, both from direct and from our accountant channel, because in both instances, it's a supported funding journey and advice is being provided. There's cash flows, there's business cases, there's all sorts of things coming into that space and understanding a credit, which means people are feeling more comfortable about doing it and transitioning through. We're seeing also that there's an increasing in urgency. It's not that we're kicking tires and having an idea, it's that we genuinely need the funds. You'll have seen, as absolutely calmed down, but you will have seen that the market's quite volatile. Jonathan talked about some of the whoopsies that might happen in the financial markets. When after the sort of trustonomics of the autumn budget, the pension fund industry went absolutely bonkers. Rates went through the moon. Mortgages got lifted and disappeared from the market. That volatility is still there. So when you're thinking about commercial mortgages and other things, products can exit the market. So you need to really be mindful that it's not always there. And whilst you might be able to achieve funding now, and the market is liquid and helpful, in 2 or 3 months' time, your own accounts might have changed and the market might have changed. So just think about like that dynamic. The second is from a credit score perspective, the businesses that we're seeing coming through are coming through with a lower credit score because of the challenges from a margin perspective, inflation, how that's eroding, all those things. The credit hurdle has gone up. I talked a lot about that at the beginning. But these last two pieces, if you think about how you manage the risk, if you're acting as a lender, and I really want you to think about that, if you're offering credit to your clients, you're effectively a lender, okay? Those businesses that are offering credit to their clients, but are tracking the risk of that, are 6 times more likely to have the highest credit score. It's not because they're tracking it, it's because they've got great husbandry of their business, probably working closely with an accountant, probably got management accounts, probably got KPIs, probably got good internal credit control. All of those pieces are there. And that makes them a great business. So whilst we might not be able to achieve all of those things overnight, if you put in a process where over the next 12 or 24 months, you're moving through these sequences to get good husbandry into your business, then you will have a much stronger business. And then finally, only 29% of businesses that come through Capitalise knew their score before coming to Capitalise. Okay, that means 71% of the businesses, we might have a positive bias because you're thinking about and logging into webinars here, but it means 71% of the businesses that are logged in here might not actually know their credit score. Now, given everything I've said, go and check it afterwards. So let's think about the lender types that are out there. So broadly, we can bucket them into three types. There's obviously the tier ones, the high streets. They are going to be your best forms of lending. Absolutely. If you've got good relationships with them, you're going to get the lowest prices. It's going to be much more relationship led. You're going to be in that context if you're more sizable to be able to do it. And the invoice finance, trade finance type pricing that you can get on international type things is going to be second to none. Okay. But if you're unable to achieve the lending that you need, you might be able to get lending, but you might not be able to get as much lending as you need. It starts to push you into a second place when you're into like challenger banks and independent lenders, whether it's kind of Aldermore's, Hampshire Trust, Shawbrooks, Bibbies, whoever it might be. You're suddenly into like tier 2 type solutions. They're probably going to be more product centric. They're going to have a little bit more risk appetite. They're going to be a bit more sensitive about niche countries that you might be working in, but you can get those away. And then of course there's been the big advent of fintech lenders, whether it's kind of Funding Circle or Walker. These people are more kind of algorithmically led. They can get you the money much faster, but probably higher price than the two above. Now, if you think about the direction of funding over the years, there's been a really big sea change in the last 12 months. So the British Business Bank's last SME lending monitor outlined that 55% of lending was done outside of the high street. To break through that 50% was, a big barrier, and it looks directionally set to continue. And one of the reasons that is that when we go through a sort of, whilst we're not in recession, whilst we've got some stagflation, it feels a lot like we're in recession. And whilst we kind of go through those times, typically lending rotates. It goes from tier 1 into tier 2, tier 2 into tier 3, and sadly tier 3 kind of drops out. Because of the amount of lending that has been supported through the pandemic, there's a lot of debt in that environment. And so that traditional tier 1 into tier 2, tier 3 cycle is not necessarily happening. And so that growth in the challenger fintechs, I think, is very sustainable over the kind of next 5 years or so. So when it comes to lending products, I'd really like you to be open-minded about how you think about funding. So I've simplified this grossly to some extent, but really there's kind of traditional working capital type finance, whether it's your overdrafts or revolving facilities. For the retailers, wholesalers, there's securitize against, the EPOS machines that you're using, the payment gateways. Obviously, if you're fortunate enough to have some secured property within your business, that is going to be the cheapest source of funds. Bricks and mortar continues to be the cheapest funding and finance that's out there. They're always there. It's difficult to see the building move. It's super secure, and it's the bedrock of all lending, in Western economies. Invoice and trade, particularly interesting to international and community, is a really interesting sector. Absolutely vital. It's about £80 billion worth of financing into the UK economy every year on a rotational basis. The invoice side of it, has some challenging history back in the 70s, 80s, and I'm thrilled to say that, as we sit here in 2023, all of those things are long behind us. But it still does get marred from the accounting community. But incredibly valuable. And if £80 billion per annum is not a large enough number to think about the importance of that as a financing tool within the UK, I don't know what it is, but happy to answer any questions. And then, asset finance has been the fastest growing lending product. So whilst lending is growing, I talked about the Bank of England shrinking, in terms of the lending pool. Asset finance has been the one product that has been growing. So, think white vans, plant machinery, it really is a, sort of systemic hotspot for SME lending within the UK. All of these are available to you. One of the challenges about going to a single lender is that they might have one or some of these lenders. They won't have all of these solutions. So having an open mind about how you solve your external working capital. So solve all your internal working capital first, credit scores, credit control, all that good stuff. Then plan with your accountant, plan what external working capital you're going to need, and think about it methodically, because when you come to look for financing, it's really important in terms of how you present yourself. A good looking business, for a lender, somebody that they really get excited about. They've got clean bank statements, no missed payments. They've got good personal credit of the directors. They've got a well-defined purpose for the funds. What lenders really want to see is that the money come into the business to grow the business. They don't want to see money to go into the business and then go out to a director or to an exiting shareholder, or just to disappear. When you think about that probability of default that I talked about, and why credit scores go up and why lending gets easier for businesses that are over 2 years. Lenders typically look at 2 sets of accounts and then they spread between the two and they take a view on your business. I can see between year 1 and year 2 that you've got positive trajectory. I can see between 1 and 2 you've got negative trajectory. Obviously, if you've got year 1, 2, 3, 4, 5, then they can plot a line. Effectively, lenders want to see lines, not dots. If you're one dot, okay, it's harder for you to be lent against. Low level of existing debt. Unfortunately, we see, most of the businesses coming in now, they do have debt, pandemic related loans, but obviously the lower level, the better. Clear affordability and serviceability. Pre-pandemic, it was possible to kind of get up to 5 times EBITDA lending. It's probably more like 3 times now. But kind of 1.25 times debt servicing cost is probably a good benchmark for you to be thinking about. And then, of course, finally, any additional security that you can provide is going to be critical. So I don't want to sign a PG. Difficult answer. I haven't got any security to provide. Not necessarily a problem, but the more that you can provide, the better it is. Ultimately, a lender's principal concern is, will I get the money back? Okay. Once they can tick that box, they start to then think about how much money can I generate from an interest return perspective, and what's my return on capital? Can I get my money back? What's my return? 2 different layers. If you can help them with the security piece, you're going to get cheaper financing. And just to kind of like round this all out, I think that if you can basically get your internal working capital in control, if you can understand your credit score and the credit risk of the clients that you're working with, if you can start to plan with accountants what the cash flow is that you're going to need over time and the external working capital, you can come as a good-looking business, to the lender market. If you've done all of those pieces and you've maximised all of those elements, then your chance for financing, whether it's internationally or domestically across those product sets, is dramatically increased.
Oh, just a big thank you for all of that insight. And I think it just really does highlight, the importance of getting good advice and setting yourself up on the right track, especially when you're looking at new markets and you know when those working capital requirements might be needed. I am always particularly taken by your comments around, improving the availability of finance and actually also improving the rates that you can get. So you improve your choice and the rates. And I think that to me is one of those clear messages that comes out there about the importance of spending time on this. How much time typically do you see some of your businesses take when they're looking at these areas? I think you intimated that it was built into the process for everyone.
I think that let me just try and change the question.
Yeah.
Many businesses think like consumers, and they think that debt is a terrible thing. Debt spent on the wrong things is a terrible thing, but debt that is well managed into a well thought out plan that has an oversized chance of returning money on top of it, is well utilized leverage. The reason I kind of give that slightly complicated answer is that if you're putting all of these things and you're being sequential in your thinking about how you approach the financing market, then you're going to give yourself the best potential outcome, because you've got the cash flows, you've got the affordability, you've got the credit scores, you've got the husbandry, you can deliver those things in. Sadly, what we see, and this comes from businesses and from the accountants that we work with, typically a business will come in with a need of just 7 days. I need the money to pay VAT. I need the money to pay payroll. I need the money to get this order in, whatever it might be. And they're probably in duress at that point. Okay. And at this point in time, I go back to, the early thing that Jonathan said about a financial market whoopsie. Okay. Silicon Valley Bank didn't think that there was going to be a financial whoopsie. It shut down a hugely successful bank that was using capital adequacy ratios based on what was perceived to be okay because they bought US treasuries. Okay, that's a financial whoopsie. The UK pension system almost shut down for exactly the same reason in the gilt marketplace. These are whoopsies that are way beyond our control. Okay, so if you run into a 7-day need and you're in the middle of a whoopsie, you're going to have some challenges. So I think it's all about that preparation.
Yeah, and I think that area where you're saying around credit terms, you can actually agree and negotiate as well at 0% cost. I mean, it's got to be appealing to everyone on that pure saving, but actually also, as you say, avoiding those short-termisms. If you can actually get others to help and support you, especially around international trade, where we know some of the working capital requirements can be slightly higher. I think it's very, very important message. We've run out of, unfortunately, we've run out of time, and I'm sure there are many instances or many questions that could be asked. But please do have a look. Do carefully consider what's been said today. There are some real great opportunities out there in the international trading market, and this is really about how you put your business into a great place where you can take advantage of a lot of those opportunities. It is worth the time. It is worth the effort. Do please go speak with your accountant, or if you're an accountant, actually consider what other processes you want to be put in place to support your clients going through. Thank you very much for joining, and I hope you will be listening to some of our other sessions during International Trade Week. As I said, very much enjoyed some of these, and a big thank you to both Jonathan and Paul for really great insight there. Thank you very much.
Just to say, sorry, Ben, I was just going to say
one quick question has come up. Yeah. Can we get the scripts? We will have a pre-recording on these, and you will be able to access them and listen again in your own time. So there is a pre-recording of these. Many thanks.
Thanks, everyone.